Good evening, everyone. Welcome to the last session of the day. We have two interesting papers on fintech lending. The first being Invisible Primes, Fintech Lending with Alternative Data, and it's presented by Professor Dimuthu Ratnadiwakara.
All right. Thank you for including our paper in the program. This is joint work with Marco DiMaggio and Don Carmichael. In this paper, we study the use of alternative data by a fintech lender in the consumer lending space. So let me start with this figure, which is based on a survey conducted by Upstart, the lender we study in this paper. According to the survey that they've conducted, when you look at the individuals with some type of credit product, about 80% of those individuals have never defaulted on any credit product. But when you look at the mix of credit these people used, only 48% of these people used bank quality credit. So this mismatch highlights that there are systemic issues in the credit system, particularly in the way the borrower's creditworthiness is measured. So one of the primary reasons for this mismatch is the way lenders typically measure potential borrowers' creditworthiness. Credit models in the consumer world are primarily based on the credit score and maybe a handful of other variables. Oftentimes, there are minimum credit score thresholds. If you fall below these thresholds, you are invisible to these lenders who use credit score as their main measure of creditworthiness. And even if you qualify, your interest rate and your loan amount is highly correlated with your credit score. The credit score is not actually a bad predictor of default. It seems to work well on average. So these are two plots where we're trying to see the predictability of credit score in predicting credit card defaults and mortgage defaults. So you can see that it works well on average. There is a strong negative correlation between credit score and the default behavior. But this average relationship that we saw masks a lot of heterogeneity within each credit score bid. Particularly in the left side of the distribution, there are a lot of different types of individuals who are lumped together, and the credit score is not sufficient to model all the real-world complexities. And let's take, for example, a recent graduate starting their first job or a recent immigrant. Both of these people will have a very low credit score because they have a short credit history, but that doesn't necessarily mean that they're not credit worthy. But traditional lenders who rely on the credit score don't see these people because they fall below their credit score thresholds. This is if you have a credit score, and there are about 53 million Americans who don't have a credit score at all. So these are credit invisibles. Lenders don't even see these people. If you apply for a loan, you will be disqualified because the lenders are not able to pull your credit report. And these people tend to be younger, and also low-income people are more likely to be credit invisible, and minorities are also more likely to be credit invisible. So if you go beyond the United States and if you look at the developing countries, this picture is worse. The vast majority of the people in developing countries don't have credit bureau coverage. All right, so after 2008 financial crisis, we have seen a number of fintech lenders who have emerged in the consumer lending space, who tout the use of sophisticated algorithms and alternative data and use online platforms to originate loans. And in this paper, we are studying whether the use of these modern underwriting algorithms can potentially remove some of these inefficiencies in the credit system. So specifically, these are the questions that we are trying to answer in this paper. We are trying to see if the use of these modern underwriting algorithms lead to broader credit access and also lead to lower interest rates to these invisible primes, as we call them. And also, what type of data are most useful in identifying these types of invisible primes? And also, whether this is a sustainable business from fintech lenders' point of view, as in whether the lenders are able to generate risk-adjusted returns by lending to these people. And finally, what are the consequences that these have on the invisible primes who are able to borrow from these fintech lenders? So one of the main empirical challenges we have here is the counterfactual. Right? If you want to know whether the use of these underwriting models lead to broader credit access, we need a way of identifying the counterfactual, so we can say that had these lenders used more traditional models, this is what would have happened, and this is what we see when they use the more modern underwriting algorithms. So we are able to overcome this challenge to a certain extent using Upstart as our setting. So we got access to anonymized administrative data from Upstart, which is a major fintech lender traded on the NASDAQ. And Upstart is known for the use of non-traditional variables such as education, your employment history, and your digital footprint in the underwriting models. And also Upstart received blessings from the CFPB to continue using these underwriting models. So CFPB evaluated Upstart's underwriting model and compared it with a more traditional model and concluded that this doesn't lead to discriminatory practices. So they were allowed to continue with this underwriting model by issuing a no action letter. And most importantly, we have access to this model that CFPB developed using this data. So this is a logistic regression model that uses about 1,600 variables based on the credit report. And CFPB used this as the benchmark to compare Upstart model with the traditional model. So here are the main takeaways. So we show that when you look at the loans originated by Upstart, the credit score is not a good predictor in this sample. So this sort of suggests that Upstart is not relying heavily on the credit score. And then when you look at the actual measure that Upstart is using, this is expressed as a probability of default, that Upstart's underwriting model outcome. And we see that that model predicts default well. And then using that traditional model that I talked about, we show that about 25% of the borrowers with low credit scores would have been denied credit had Upstart used that traditional model. And this is extensive margin effects. And then if you look at the interest rate that these people were charged, had Upstart used this traditional model, they would have charged a much higher rate, particularly when the credit scores are lower. And then we find that the impacts are larger for individuals with thin credit files, younger individuals, and individuals who are highly educated. And when you look at the profitability of these loans, we find that Upstart is actually able to generate a higher return by lending to these invisible primes, even though they're charging a lower return, lower interest rate. And when you look at the impact on invisible primes' financial health, we see that their financial health improves after receiving credit from Upstart. And then we use publicly available mortgage data to show that these kind of patterns are not unique to Upstart samples. So we are able to replicate some of these results using publicly available mortgage data. All right, so when in our sample, we have more than 770,000 loans originated by Upstart, and we have data on more than 2.3 million applications. So the time period is from 2014 to 2021 first quarter. And we have access to all the credit report variables. It's about 1,600 variables at the time of application for both the funded loans and the disqualified applications. And we also have performance data for the funded loans. In addition, we have information on these alternative variables that Upstart is using in their underwriting models, such as education, digital footprint related variables, and employment related variables. There are three key features in our data set that is different from the other data sets that we have seen in the literature, so that enables us to answer some of the questions that were previously not answered. So one of the key features here is that we have access to almost all the variables that Upstart uses when they develop the underwriting model. And then we have access to the traditional model that CFPB developed as the which was used as the benchmark to compare Upstart's underwriting model. And then we have a panel of both the funded and rejected applicants. That is, Upstart is able to pull credit reports of disqualified applicants for a period of 12 months after the point of application. So we can observe their financial health following the application. We can observe their financial health after 12-month period. So we can compare the financial health of funded borrowers and disqualified borrowers. So this should give you a sense of Upstart's loan portfolio. So you can see the number of loans are growing rapidly. In 2020, they originated about 300,000 loans, totaling up to more than $3 billion. And most of these loan applications come through loan aggregators such as Credit Karma, LendingTree, and NerdWallet. So this sort of minimizes the concerns about selection bias, because these people go to these platforms and they don't know they're going to Upstart, but they see Upstart's offer and then they come to Upstart's website. And so that's the majority of the applications. And most of these loans are for debt consolidation and credit card refinancing purposes. When you compare the funded loans to disqualified loans, you can see in the funded sample, the average credit score is 653. This is different from what you typically see in consumer lending portfolios. You see much higher scores. So Upstart is concentrating more on the left-hand side of the credit score distribution. And you can see other characteristics are slightly better. If you look at the alternative variables that we are concentrating on, the bottom ones, you can see the funded borrowers are more likely to be college educated, and they're less likely to be hourly workers. And also they're more likely to have used a computer to fill out the application. If it was a computer, it's more likely to be a Mac. And if it's a smartphone, it's more likely to be an iPhone. So this is consistent with the paper in RFS, Manjupuri and co-authors. They've shown that these variables help in identifying good borrowers. So Upstart also uses similar variables in the underwriting model to identify good borrowers in this particular segment of the credit score distribution. All right, so we start our analysis by looking at the predictability of default. So what we're doing here is we've grouped all the loans that Upstart funded into 4 categories based on the credit score. And ordinarily, we would expect that the actual default behavior to be negatively correlated with the credit score. But as indicated by these blue numbers, you see that there is no correlation between credit score and the actual default behavior. We have a more formal model in the paper with fixed effects and bunch of control variables, but the idea here is that the credit score is a very poor predictor of Upstart's default behavior of Upstart loans. And now if you focus on the probability of defaults, so which is the outcome of the Upstart's underwriting model, which is given by this blue density plot, you see a large variation of that measure within each credit score bin. So what this means is that Upstart is saying, if you focus on the top 2 panels here, so these are the borrowers that are invisible to traditional lenders because FICO scores are less than 650. Usually the minimum threshold is about 660 or more. So these borrowers will not qualify for a personal loan from a traditional lender. So but Upstart is saying, even though the credit score is lower, the probability of default is very low. So they're probably of good quality. And also on the flip side, if you look at the highest credit score bin, you can see that even though the traditional or the credit score suggests that these borrowers' creditworthiness is high, Upstart is saying for some of these borrowers, the probability of default is very high. And turns out Upstart is correct. Like if you look at the actual probability of default, actual default rates, realized default, you can see there is a positive monotonic relationship between Upstart's probability of default and the actual default rate. So this sort of suggests that Upstart is able to identify these different types of borrowers within each credit score bin. So we'll get to whether it is using alternative data or whether this is due to the more sophisticated model, but their model is seen to be doing a pretty good job in identifying the different types of borrowers in each credit score bin.
More clarifying.
Yeah. X-axis is the probability of default. So that's the measure that Upstart is using in the underwriting decisions. 40%? Yeah. All right. So now the next question is whether this superior performance is due to whether this is due to the use of alternative data or whether this is due to the use of more sophisticated models. So Upstart's probability of default is based on a gradient boost algorithm. So is it because is the superior performance due to this model, or is it because Upstart is using this alternative data? So we first look at the contribution of this alternative data to predictability. So here what we're doing is we are regressing that Upstart's probability of default on a bunch of variables plus fixed effects. And then, so that's column 1, and each of the following regressions, we are adding these alternative variables as fixed effects. We're not allowed to show the coefficients because then the borrowers will be able to use that to manipulate their behavior. So we had to include these as fixed effects. So you can see the R-squareds go up. And also if you focus on the last row, that shows the maximum economic impact. So this means the probability of default, if you focus on the column 2, goes down by 4.2% when you go from the lowest level of education to the highest level of education. Average probability of default is about 22%. So this is about a 25% drop in the probability of default due to education. So this should give you a better sense of how important these alternative variables are. Let's just focus on education. And if you hold credit score, loan amount, and age constant, and if you compare a borrower with no college degree and a borrower with an advanced degree, for the borrower with no college degree to get the same probability of default, that borrower needs to have 107,000 more in that borrower's income. And if you do the same with the credit score, that borrower needs 40 more points in the credit score to get the same probability of default. So that difference is due to the difference in the education. All right, so that sort of tells us that, okay, alternative data is playing a big role in Upstart's measure of underwriting, Upstart measure of creditworthiness. Now here we are trying to sort of disentangle the contribution of alternative variables and the model. So here we are looking at 5 different models and looking at the predictability of default of each of these models. We start with the credit score, and we see the area under the curve is about 54%. And then we develop a basic model with a handful of other variables. With the credit score, the AUC increases by 4 points. I don't have to tell you that 4-point increase is a very big increase when it comes to AUC. And then we use the traditional model. So this is the model that CFPB developed, and that increases the AUC by 2 points. And then when you add those alternative variables to this traditional model outcome, we see a big jump in the predictability from 60 to 64. So this difference is due to the inclusion of these alternative variables in the model. And then the last line is the actual underwriting model that Upstart is using, and what's the predictability of their estimate of the probability of default. And we see increase of about 2 points. So it's a significant increase. So Upstart is using basically the same variables this traditional model plus alternative variables model is using. So we can interpret this difference as due to the model. So in summary, the alternative data seems to be playing an important role in Upstart's underwriting model. So now the next thing that we are looking at is, what does this do to the credit access, whether this improves the credit access. So if there is one slide that you want to remember from this presentation, it is this one. So here we are looking at 2 different models. One is the Upstart's actual model, and the other one is the traditional model that CFPB developed. And we are looking at all the applications, and we are looking at the outcomes of these models. And you can see for the borrowers with credit scores less than 700, about 25% of these borrowers would have been denied credit had Upstart used that traditional model. But because Upstart used that alternative variable and used that more modern underwriting model, these borrowers were able to get access to credit. And here we are looking at these 2 darker shades of blue, that pool of borrowers. So these are the borrowers who got funding from Upstart. And now we are using an actual underwriting model used by a large bank. This model is based on the debt to income ratio, credit score, and the loan amount. And we can see that, so here the left-hand side variable is the whether the borrower would have been denied using this other model. So you can see borrowers with FICO scores or credit scores less than 660, all of them would have been denied had Upstart used this the model used by the other bank. And now this is the traditional model, the one CFPB developed, and we don't see much of an improvement going from the model of the large bank to the traditional model. So in summary, so a lot of these borrowers with low credit score wouldn't have received credit had Upstart not used those alternative variables. And we see a similar picture when you look at the interest rates. So this is relative to the interest rate of the highest credit score bin. So you can see that the light blue line is the interest rate suggested by the traditional model, and the dark blue line is the actual interest rate these borrowers received. So you can see there is a very big difference in the actual interest rate these people received because of the use of this more modern underwriting model. Okay, so now we are looking at the heterogeneity, who benefits the most due to this use of alternative data. So this regression sort of suggests individuals with thin credit files, individuals who are highly educated, and individuals who are salaried, not hourly workers, are more likely to benefit due to the use of this alternative data, and these effects are stronger when the credit score is lower. And here we are looking at the minority fraction, the fraction of renters, and foreign-born population fraction. This is from the census, so we use each borrower's zip code, and we get the census data and we proxy because we don't have this information, and we see that minorities and renters and foreign-born people are more likely to benefit due to this use of alternative data. So the next thing that we're looking at is whether this is value enhancing to the lender, whether Upstart is able to generate sufficient return by lending to these invisible primes, because they're charging a low interest rate, and what kind of return are they generating? So here what we are doing is we are looking at credit score bin year portfolios. For each year we have credit score bin portfolios, and we are calculating IRRs. And we can see when the credit score is lower, Upstart is actually generating a higher return. And this doesn't depend on the type of the model, irrespective of whether the borrowers were only approved by Upstart model or whether the borrowers were approved by both Upstart and traditional model, doesn't make a difference. And finally, we're looking at the impact on borrowers' financial health. So here we are exploiting a discontinuity in the qualifying criteria. If the borrowers have a debt-to-income ratio of about 50%, then those borrowers don't qualify, and we use this in a regression discontinuity design, fuzzy regression discontinuity design. We instrument the dummy variable funded using whether the debt-to-income ratio is greater than 50% or not. And then we look at three outcome variables. First one is after so we are looking at 12 months since the point of application, and then three outcome variables are whether these borrowers defaulted on their credit cards, what happened to their credit score, and whether they applied for a new mortgage. Here we are restricting the borrowers, the applicants, to the ones who didn't have a mortgage at the time of application. So this means if they have a mortgage, they're more likely, it's very likely they bought a home first home. So we can see that, and then we split the sample into two categories based on the credit score, less than 660 and greater than 660. And we see statistically significant and also economic significant effects when the credit score is less than 660. They are less likely to default on credit cards, their credit scoring improves, and they're more likely to purchase a home. And so this is this is from the mortgage data. So we see we are comparing Quicken Loans, which is a fintech lender who has about 10% market share in the mortgage market. We see that the credit score is not a good predictor for the mortgages originated by Quicken Loans compared to the mortgages originated by large banks. And if you look at the credit score distributions, we see the Quicken Loan has more borrowers with lower credit scores compared to the large banks. So I have 40 seconds to conclude. So in this paper, we use this administrative anonymized data from Upstart to show that use of alternative data in underwriting models lead to broader credit access, both in the extensive margin and the intensive margin. And then this leads to better financial outcomes for the borrowers, and the lender is also able to generate a higher return by lending to these invisible primes. Thank you.
Right. Well, first, I would like to thank the conference organizers for giving me the opportunity to discuss this paper. So Dimuthu did a great job of explaining the paper. So I'm just going to quickly recap his findings. Now, the broad overview of the paper is that the authors explore the use of alternative data in the consumer lending market. To do this, they have access to proprietary data from Upstart. Now, what's unique over here is that they also have access to Upstart's lending model. The key thing that they do is that they compare Upstart's lending model to a traditional lending model that they have gotten access to from the CFPB. Now, some of the key findings here are that they find that the Upstart model is basically outperforming traditional credit scores when it comes to predicting defaults. When you look deeper into what is causing this outperformance, they see that it's actually the non-traditional variables, basically education and employment history, that result in Upstart outperforming the traditional credit score. They also find that Upstart does a great job in expanding credit to consumers that are traditionally locked out of the formal banking credit market. So these are basically borrowers with low credit scores, borrowers with thin credit files, or borrowers from underserved regions. And the positive effects occur along both the extensive and intensive margins. So not only are these borrowers getting access to credit that they would not have otherwise gotten, but they get access to it at a lower rate. So first impressions of this paper are that, the data is obviously very unique, and the research question is of first order importance. Moreover, this research is actually consistent with some recent initiatives that are at play at credit bureaus. So as a personal anecdote, I've been, working at Equifax working on some internal projects at Equifax, and I've used Equifax data in my own research for the last five and a half years. And one of the key things that's very hot right now is scoring the next billion people. And that initiative is obviously going to rely on using alternative data to answer this question. So obviously this paper then is poised to make a significant contribution in this domain. So the overview of my discussion is simply going to be, I'm going to focus on some big picture comments. And as part of these big picture comments, I'm focusing more on the interpretation of the results, as well as any implications that they might entail. And then I'll have some brief comments regarding the empirics, as well as some general questions about Upstart's model. Right, so the first thing that was very interesting to me when I read the data section of this paper is that it appears that nearly 1 in 6 of Upstart's borrowers are unscored at the time of loan origination. Right, so if you don't have a credit score, you're likely locked out of receiving formal credit from the banking sector. So in this case, what I find is that the authors are actually silent on this issue. These borrowers that do not have credit scores at the time of origination are excluded from the analysis. And what that results in is basically maybe an understatement of the capabilities of alternative data towards financial inclusion. So some things that I would be interested in as a reader would simply be the differences between these unscored and scored Upstart borrowers. You can focus more along the lines of the characteristics of these borrowers at the time of loan origination, as well as their performance. Now, the other thing that would be of interest, obviously, is how Upstart actually goes about making loans to people that don't have formal credit scores. However, the big question that can really be answered here is whether Upstart loans making use of alternative data are able to help unscored individuals enter the credit file or receive formal credit scores, which then would obviously, give them access to the formal banking sector. So the second thing that stood out to me was when I looked at the area under the curve analysis that was conducted. Now, the AUC analysis that the authors conduct is basically comparing the predictability of credit scores versus Upstart's measure in predicting the default on Upstart loans. AUCs range from a low of 50%, where you basically have pure random prediction, to a high of 100%, where you have perfect prediction. So in the version of the paper that I saw, the AUC for the credit score alone was about 51%. Right now, having worked with credit score data for 5 years, I do know that credit scores are maybe an imperfect measure of the creditworthiness of a consumer. However, I was a little surprised to see that the area under the curve analysis suggests that credit scores are about as good as flipping a coin when it comes to predicting defaults. Now, this was maybe not consistent with my priors, so I went and dug into the literature, and what I found is that in the German data, the credit score AUC is approximately 68%. Right, so in this case, one thing that maybe I would encourage the authors to do is maybe analyze whether the set of borrowers that they're dealing with, the borrowers from Upstart, well, are they unique? Is the credit score AUC finding kind of generalizable to other settings as well? But basically a broader discussion of the kind of borrowers that are attracted to Upstart. Now, Dimuthu actually covered this as well. Effectively, what he finds, what the authors find in this paper, is that about 40% or so of the loans that are originated at Upstart come through referrals from Credit Karma. Now, Credit Karma is basically a lending aggregator. The lending aggregator will allow consumers to shop for multiple credit products and then, pick the best credit product for them. What's been shown, though, in the literature is that customers that make use of price comparison sites tend to exhibit better loan performance than maybe, the customers that are going to be accessing the site from a paid ad, right? So the question over here then becomes, well, is there some kind of maybe selection going on? Is it really the borrowers, alternative data that's being priced through Upstart, or is it the fact that a specific type of borrower is self-selecting onto Upstart, which is maybe explaining, the better loan performance of Upstart's borrowers? So one thing that the authors could potentially explore here then is whether the performance varies across the different types of referrers, and if they find a consistent result, regardless of the type of referrer, then you may be able to address partially address some of the selection concerns in this situation. Then the next point that I came across that I was very confused by, actually, and I found very interesting, is the authors dig deep into finding out what is resulting in Upstart outperforming the traditional banking model. Why is Upstart better able to approve loans that the traditional banking model would have maybe otherwise rejected? And what they do is they make use of a machine learning algorithm, and what they find is that the stated loan purpose at the time of application plays a significant role in Upstart's approval decision. Now, in this case, when we talk about fintech loans, the reason that's stated in the loan application is generally considered to be non-verifiable because there's no enforcement mechanism in place to ensure that the loan is used in a manner that's consistent with the reasons stated on the loan application. What's more interesting, though, is that the stated loan purpose, in this case, debt consolidation, is actually playing a bigger role in Upstart's approval decision than stuff like the number of credit inquiries, the income of the borrower, the liabilities of the borrower, the number of accounts of the borrower. So in this case, it almost comes across as if Upstart is placing a higher weight on non-verifiable information rather than verifiable information. Now, unless of course, Upstart has some mechanism in place to ensure that loans are used in a manner that's consistent with the reasons stated on the loan application. In any case, prior research has documented that non-verifiable info does matter for fintech loan approval. However, that was under a peer-to-peer model that involved unsophisticated retail investors if this is a fully automated model, then the authors probably should explain that in a little bit more detail. I thought that the analysis with regards to the alternative data benefits for underserved populations was really cool. I thought that it's great that Upstart seems successful in providing additional credit to regions, to borrowers coming from regions that have a higher minority share, higher share of foreign-born individuals, as well as a higher fraction of renters. Now, along this same theme, the CFPB has published some data points on credit invisibility, as well as the unbanked and underbanked consumers. Now, effectively, all these research reports talk about is who these people are and where they come from. So some of the key findings of the data points are, that people that tend to be credit invisible or unbanked or underbanked are basically consumers that are low income, young, generally come from rural areas and are very far from depository institutions. Now, obviously, the authors have accounted for some of these cuts, but maybe the CFPB data points will provide some additional resources for you guys to go through to think through some of the cross-sectional cuts. And when I was reading the paper, one of the key things that came to my mind was, well, are these results externally valid? And I was really happy to see that the authors actually, took this issue to heart as well and tried to mitigate concerns of the sort. Now, the way they tackle this issue is that they explore whether alternative data matters in the mortgage domain. However, maybe I found this part of the analysis a little less convincing for two reasons. The first one being that the definition of fintech versus non-fintech lenders is somewhat inconsistent across the analyses, which makes it very difficult as a reader, makes it very difficult to follow as a reader. Moreover, I found that the paper could use a little bit more motivation with regards to what constitutes alternative data in the mortgage space. There's certain variables that are used, such as debt to income over 40% or age under 45. It would be good to see why these particular cutoffs were used. Are these cutoffs motivated by machine learning techniques, or are they motivated by the Upstart model? Just more discussion on this issue would be helpful. Now, ultimately, this may just come out to be a difference in taste, but what I thought was great was a discussion of external validity in Berg et al. And if I have to paraphrase their findings to your setting, it would simply be that, well, if good current alternative data matters for future credit scores, then alternative data also matters for other loan products. And that's the key takeaway from their paper in terms of the external validity, which may or may not serve as a good benchmark for your paper as well. All right, moving on to the empirics. When studying, the expansionary effect of credit by Upstart, the way the analysis is conducted is that the authors focus on loans that are issued by Upstart and then explore what fraction of these loans would be denied by the traditional model. However, by doing this, you miss out on the other side of the coin, which is that you may actually miss out on loans that are approved by the traditional model, but rejected by Upstart. Now, I'm not saying that it's going to be a significant share, but what that does happen is that it does result in you overstating the complementarity effect of Upstart's credit provision. Instead, maybe the authors could consider some application level analysis where you feed the same application into the traditional model and Upstart's model, and then compare approval rates, and then also study how those approval rates will vary across the various cross sections that you're considering in your cross-sectional analysis. I also thought that the impact of Upstart loans on the credit score was to be muted. Actually, I was not sure how to interpret the coefficient. Is it 0.01 points, 0.01%, or 1%? In general, what I thought was that the effect appears to be economically smaller compared to some of the other papers in the P2P loan literature. I was also not sure if I followed the analysis regarding obtaining mortgages after Upstart loans. It's important to realize the magnitude in the situation. Upstart loans on average are about $11,000. And, this loan amount is presumably smaller for borrowers that have lower credit scores. Moreover, Upstart loans, if they're used for credit card consolidation or debt consolidation, they're not going to reduce the total balance of the individual. In terms of the regression discontinuity design analysis, I would just like to see some more visuals regarding bunching around the cutoff, as well as, I think you're missing a polynomial function in the RDD analysis that accounts for the relationship between X and Y around the cutoff. In general, I would also like to see a discussion of the RDD estimates. They seem to be 8 to 19 times higher relative to some of the baseline estimates. And then some other things to consider, are these results specific to the time period of the study? A large portion of the data comes to be during an economic upswing. Also, are these results specific to the model? We know that B2B models tend to change over time. And lastly, I'll just conclude with some general questions that I had about Upstart, specifically what kind of credit scoring model is used. Are we making use of a Vantage 3.0 or a Vantage 4.0? The reason this is important is because the Vantage 3.0 will make use of untrended credit scores. Basically, a one-time change will affect the credit score significantly. If you make use of trended data in the Vantage 4.0, a one-time reduction in credit card utilization will not. So anyway, general questions. So I'm sorry for going over time.
Thank you so much, Nikhil.
Yeah.
Dimuthu will take the questions now.